Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Rice raw sugar in New York. Now, the main immediate pattern here since September 2024 had been, and I suppose still is after a fashion of sorts, the breached and seemingly repaired dark blue September to December 2024 bear channel, currently 1565 to 1896. Though in recent times, the bright pink late September 24 to mid-January 25 bearish Andrews pitchfork, which I drew 12 weeks ago, to try and help make some sense of the recent moves, is a better contender in showing the bearish angle of attack on this one. On this one today, we are in between the middle time below, currently at 1596, and the upper time above, currently at 1851. However, there's also, complementing this bearish Andrews pitchfork, a larger, longer term, bright red, November 23 to September 24 bearish shift pitchfork, which has also been pretty good at showing the bearish angle of attack over a longer term time frame. We are today, as we have been since mid-April, close to the bright red middle time below, which is currently at 7, well actually we're just below it actually, currently at 17 even is the bright red time. Now this bright red middle time along with the bright pink middle time have helped hold up the market, though they are bearish patterns, and that's been on a number of occasions they've helped hold it up, or slow it I should say. However, all these three are still indicative of a market pushing lower, but as I said 5 weeks ago, and I quote, we have also support below from about 1750 down to about 1650, though it is a declining support, and once past the pink middle time, the support begins to dissipate. End of quote. Now, a key support that has been breached and is now acting as resistance is the important overhead level at 1809. This is because it is the interesting 50% absolute Fibonacci line for the whole of the 21st century. Despite challenges, we are now well below this 50% Fibonacci line. Now this Fibonacci line, along with the 50% Fibonacci line of the April 20 to November 23 move at 1859, have in the past worked together as significant supports and an eroding force for some of the bearish incentives. Now, well, they will act as capable overhead resistances, but I'm wondering if they really need to do that, as the pressure is still for lower. And as I said earlier, the supports for what they are declining. We are right now testing the April 2017 high at 1716. But effective supports below would be at the May 2017 high at 1659 and the February 2020 high at 1591, all quite old. Now I also went back 6 weeks ago back to my monthly charts in a further attempt to get a handle on what technicals were operating here. And the major pattern I saw there, which is still working, is a double top, an Adam and Eve type that had been constructed throughout 2023. This had already reached its primary target 1880, but it still left alive a secondary target, target X, which you can see on this daily chart, at 1630. This, as I've said for so many weeks, this longer term pattern is the one I choose to watch and see how it develops. However, it all depends if prices can properly break down through the bright red middle time and then exploit the move lower. Or will we see the market sliding along this bright red middle time as it has done recently, in which case we'll have to wait until early to mid-July to see prices down there. Ice Europe white sugar in London. After all this time, there still continues to be three features in this market to bear in mind on this daily chart. The first is the obvious and broken, though now coming back once more to being repaired, purple late September 24 to mid-February 25 descending expanding wedge pattern, currently 5F460 to way off the bottom of my daily chart. This pattern has more than the requisite 5 touches necessary, made by January this year, and had been severely tested on the top side between late February to mid-April, enough that I would not classify it as a descending wedge pattern after February, though I'm still keeping an eye on the extension to the upper trend line. The break upwards in mid-March reached up as far as the February 2017 high at 565, and in the process raised the question as to whether the action since February was a form of bullish halfway hesitation or a double top or something else. Today we can see it was a double top, though there had been some marked reluctance to fulfill its potential on the downside. Nevertheless, the primary target, which I had previously highlighted, was reached mid-April. And the secondary, much harder to reach target X, is down in the 464 even area. Not too far away now. We've had attempts down towards this number, but as I said earlier, with reluctance, at least until last week. Hence, that was why I said 7 weeks ago and I quote, to always keep an eye on the bright pink late September 2024 to mid-March 2025 recently finessed bearish shift pitchfork. We are right now in between the overhead upper time, currently at 551.60, and the middle time below, currently at 493.30. This is a very shallow pitchfork, and the more the market moves lower through it, the more I'm beginning to like it. End of quote. Well, since then, the market started utilizing the bright pink middle time as an attractor, riding prices lower in a shallow glide until, as I said, until last week. Therefore, I added 3 weeks ago that, and I quote, it may take some time to get down to the 464 level if prices really want to. End of quote. What has been interesting over the last few weeks is that the prices have eroded the congestion between 489 even to 490.10, quite a narrow band of support that had previously been breached but not broken. That has been previously broken back in late January. It consists of the April 2017 high at 489.10 plus congestion from late 2021 to early 22, including a quad bottom back then, along with a bright green neckline extension to the April to June 2021 head and shoulders top, currently at 490.10. We are now below these and they are resistance, but we still need to stabilize below them to allow a further attempt lower. Thus, looking lower down, the May 2017 low at 468.90 and the 2025 low at 462.60 would seem obvious supports, which is what the May 2017 low did last week. I'd also look to the August 2021 low at 442.60, but these supports are quite wide apart, though we do have congestion at 456.60. But then we have little until that August 2021 low, and we would then have another potential issue, and that is to regard the whole of the 2025 action as a possible rounded top pattern. More on this pattern idea if we see target X at 464. Sugar white premium spread. Some interesting gyrations here in recent times. 8 weeks ago we had a weekly key reversal up, though it was also a weekly indecisive doji cross. Yet with then the highest close since mid-July last year. A week later, so 7 weeks ago, we had an even more dramatic immediate countering key reversal down, pushing and closing below the declining gold long moving average, currently at 103 even. The week after that, so 6 weeks ago, we had a counter to the counter combined bullish Harami and bullish closing Mayam Rabozo. This was followed the week after, so 5 weeks ago, by a third countering bearish dark cloud cover pattern and bearish double. We then had the following week an inverted hammer pattern, which is a dubious pattern in my mind, as it's traditionally seen as a bullish reversal pattern. However, the data indicates differently in that between 6 to 7 times out of 10 it acts as a bearish continuation pattern. The market this time followed the data, though it did it cautiously, the following week being an indecisive spinning top, but it was also week 2 in a 2-week bearish separating lines pattern, followed by another inverted hammer that saw the market once more follow the data rather than tradition, and leave us last week with admittedly a lower but still indecisive doji cross, yet with the lowest low and low close since mid-February. Right now the market seems to be following the gold long moving average lower, and we seem to be heading down to the large piece of congestion below, one that I spoke about 3 weeks ago and at an earlier one that I mentioned 11 weeks ago, and I quote, so this is back from 3 weeks ago. Looking today at the market, I am more and more minded to view the topping idea favourably and start discussing the congestion below between roughly 85 even down to 70 even. This is why I said 8 weeks ago, so that is really now 11 weeks ago. And I quote, apart from the gold long moving average, we really don't have that much below until we start approaching the 85 even zone, end of that particular quote. Nothing seems to have changed on this for many weeks now, end of quote, and that's the proper end. To help see the bearishness, I've drawn a dark blue mid-April to mid-April 24 to mid-April 25 bearish Andrews pitchfork, Prices are currently in between the large space between the overhead upper time, currently at 123 3/4, and the middle time below, currently at 59 3/4. As a point of interest, I do note that the lower time is now a minus figure.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.